Hi guys, my name's Kevin and welcome to Beta Trader. Today I'm be talking to you about my trade on NIO, ticker NIO. NIO. Alright, now before we get to that trade, we gotta backtrack and talk about what happened today. So today, overall market was ripping up, just climbing. There was only buying and very few selling on overall markets. So today it was not tech that was running really hard on, because you have Facebook just chopping around. It went up but chopped around. Apple, APL ran up and came back down, but the big thing happened later in the day at around 2 o'clock. So when 2 o'clock came around, I saw this dump candle on SPY, and then I was wondering, what was going on, and BABA had this flash down right down here. So one thing happened was that there was news that came out that Donald Trump was planning to ban a couple of stocks. Baba was one of them, and Tencent. So because of that, all of the Chinese stocks started dumping. Just look at JD.com and Baidu. They started falling off. Now, when it fell off, when I was looking through all of them, and I checked out NIO. So in NIO, it already had this dump, and I couldn't get in here because it was like way far out. So what I did was I waited for it to bounce back up, and then I watched for this it start to move down, giving me a confirmation on trying to get in on more downside. So I bought right here on this candle at 237. I bought, let's see, right here I bought the $48 strike put for this week. So it's this week's expiration. Now, because it's this week's expiration, just like the time frame is pretty short, plus the volatility in here. You see this dump and this pullback. Well, because of this dump and this pullback, these stocks were like way up. The puts were way up. So when it pulled back, the price of those puts came back down, and then gave me an entry right here. So when I enter right here, the 48 put cost $55. Now this thing went straight down with all these red candles with increased volume out to here. So the volatility caused the price of these contracts to go from $55 down to up to 190 down here. So then, actually, wait a minute, already. Let's check out right here. So right down here, that was $190. Now, when it bounced right here up to here, the contracts went back down to 130. So that's how volatile the stocks, these contracts can be. So when it bounced up here, came back down, bounced around, So up to here, I decided to get take profit. So since I didn't have in this account that I traded on, it was PD. There was a PDT rule, so I didn't have a day trade to get out these contracts. So what I did was, instead of taking profit on those contracts, I sold the 47.5 put. So by selling a strike down, I locked in, let's see, I locked in 115. So that is over 100% of profit. Plus I had the 47.5 put sold out. So the difference with that is that if the stock goes down under 47.5, I can close out the spread at 48 put, and selling that and buying back the 47.5 put with the spread of $50. So I cash in an additional $50 on it if the stock drops below 47.5. After finishing up that trade, I decided to see if there's a way to enter and get more profits. So the stock price ran up, and I missed the entry right here for it to come down. So I would have entered right around underneath here, and then sold another contract out to here. But since I missed that, I had to wait for it to bounce back again. And right here at 321, I bought the 48.5 put for $116. When it ran down here, my plan was to sell the 47.5 put. So I bought the 48.5 right up here, and I was hoping to sell the 47.5 put when it ran down, and I was hoping to sell for more than what I bought the 48.5 put for, so I had gotten some more profits, and made that 48.5 put free. But since it ran down here, those 47.5 put went to 115. I couldn't get the price to 116 to make the trade free. So when it ran up, it ran all the way up here, and I got stuck. So I was afraid that it would just go straight up out to here and keep on going. So I ended up selling the 47.5 put. Let me see, where was it? Right here. So basically, I sold that put, 47.5 put, for $90. So basically, this is just a regular spread. It was a break-even spread for if I just did it right here. So that spread cost me, let's see, $26. So $26 for this spread. So I need that thing to drop underneath the 48.5 to collect profit on the spread. So we'll see what happens tomorrow and the next day, Friday, because these options right here and these two spreads expire in 2 days. So hopefully this will be profitable. The first trade will be profit no matter what. The second trade, we'll see if it's profitable. It's it just costs $26, but if it does go under 27.5, then I can cash in $100 for the spread. So cross my fingers and hopefully that works out. Okay, thanks for watching. See ya.